Welcome to the STARS program, seniors taking active roles in society. And now, here's your host, Anita Finley.
Oh, I'm just overwhelmed. After, when you like somebody, it's one thing, but when you really admire them, it's another thing. And of course, I've told you before about Rob Colson, and he is a mastermind at insurance. And I don't know anything about insurance. I mean, it's funny. I know about a lot of things, but insurance, I'm just kind of like a robot. You buy this, and you have it, and you don't know. And so I met Robert, and he said, oh, no, okay, get me your insurance policies and get me illustrations and whatever he calls it. And we're finding out so much. So thanks for coming to the show, Rob.
Oh, it's always a pleasure, Anita. Thanks for having me again.
You fill me with so much information, and I know I'm probably more typical than not of people who have no idea.
I would say that's the general conclusion. Most people have no idea what they've purchased. All they know is they bought life insurance once upon a time for one reason, two reasons, and a lot of times those reasons don't exist anymore. So the ability to look at those policies and analyze them and give the client, the consumer, a true value of what they own is really what we do. So in retrospect, we help people figure out the complexities of the insurance industry.
Well, why don't we take I don't mind sharing this with everybody. I have an insurance policy I purchased, I don't know even if I can tell you when. It could have been 30 years ago. I'm not sure. And it wasn't for a lot of money. It was $125,000. That's what I was told. And I guess I did it so that my husband, if something happened to me, he'd have, my money, right? Mm-hmm. And he did the same, but his is a little different because he did some other things. And he's much older than I am, and so it's not the same. So, all right. So I have this $125,000 policy, and every month out of the bank comes $161.
Yep, that's what they call the planned modal premium, and that's probably the same premium as you started with day one. Is that correct?
It is, yes.
So what happens in these insurance policies, Anita, is many, many times the planned premium is higher than the actual cost of the insurance. So what does that mean? That means most people are actually overfunding their policies unnecessarily. So to keep it in layman's terms, after a few years of accumulation, especially durations of 5 and 10 plus years, those account values grow because insurance companies are in the business of making money. That's how they can provide death benefits. That's how they can amortize people's life expectancies and convert that into cash when people die. What that means is when they project something 20, 30 years ago, the cost of insurance, as we've been talking about for the last couple of months, has come down dramatically. So what that means is the cost of insurance that they projected 30 years ago when you bought that policy is actually a lot cheaper than they expected. So if we can use a perfect example on your policy, you have account value or cash values in that policy over $23,000. And they're going to continue to pull that $161 a month out of your checkbook until you tell them to stop. And the reason is it's what's called a planned premium. But as you can see with a $23,000 cash balance, if you're only paying $161 a month, that's give or take $1,900 per year. Simple math would tell you could pretty much not contribute to that policy for at least 10 years without ever having that policy lapsing.
Okay, so in due respect, though, to insurance policies, let's say I died the first year, they'd be out almost $125,000.
Correct.
So what you're saying is, okay, now it's been 30 years and they're not out. Now they've covered all their losses, right? And now all the other is gravy.
Exactly, because what they've been doing is investing your money over time. And they do very well with this. Insurance companies don't very often lose money. Matter of fact, you've never seen one go out of business in the Americas today. What the basic bottom line on these products is you need to have somebody look at them. Because just like you have your accountant look at your income, project your taxes, you should be doing the same with all of your financial vehicles, especially life insurance. So what I can tell you, Anita, is there's no reason for you to have $161 pulled out of your policy every month.
That's what he told me. I'm very excited. I have to think what I'm going to do the $161. No, I love that. So Rob has said to me I should go to my bank since it's automatically taken out of my account and just tell them, write him a letter and say, don't take it out anymore. And then I also have to get you an illustration so you can even see more about it.
Well, yes. What an illustration allows us to do on your behalf is access the insurance company's current illustrations. So what that does is show what their current valuation is on your age and how much it's really going to cost to carry that policy from not 1995 or 1990 when you bought it, from 2015 forward. And again, the cost of insurance has come lower. And your account, because you've been doing it diligently, that $161 a month, just like the great customer they were hoping you would be. And lo and behold, you have a cash surplus sitting in your account. And should we have not looked at this, you'd be just like every other consumer, continuing to pay into this policy. And that's exactly what the insurance companies want you to do.
That's why I love Rob Colson. I mean, when I first met him, he told me, what he does. And I heard it, but it didn't affect me personally, I didn't think. And then he said, so I said, well, why don't I just give you my insurance policy and then you could really show me? And lo and behold, he did. And I have now saved $161. I'm going to go to the bank after I leave here. I'm going to tell them now. I'm going to write him a letter. Don't let these people take it. Now, I bet I get a letter from the insurance company once I do this.
You will not.
No?
Because after we run those illustrations, you can have that discussion with them, and they will explain it to you succinctly after you direct the question properly to them. And ask them, what happens if I don't make my premium payment for a month, for a year, for 4 years? And if you get the correct answer from them, what they will tell you is absolutely nothing.
Well, I'll put you on the phone.
Because you know what happens, to make it very simple, is that account value, that's the beautiful thing about universal life products. Those account values will pay for that cost of insurance. That's also one of the top features of a universal life policy, is the flexibility of it. But again, most people buy insurance, don't understand what the products really do. And universal life products were designed to be flexible for the consumer on the payment of their premiums.
Okay, so could I borrow on that amount of money?
Yes, you could.
How would I do that?
You can just take a loan out against yourself. It's a simple loan against that policy.
I can?
You can.
But I have to make sure what I take out still leaves enough money in there if I'm not going to make that payment every month, right?
That is exactly correct.
So how much money would I be able to take out of that?
It depends on how long you don't want to pay your insurance for.
Oh, okay. So let's say that I wanted a loan of that $25,000. As long as I keep paying $161, am I all right?
Yes, you would be.
You have just done a lot more for me than you even know. A lot more, because I have some stuff that I really wanted to take care of. Oh my gosh, you are. And the big thing is, he hasn't charged me, and that's not because he just likes me. It's because he doesn't charge for this, because he knows that there'll be things that we can do together with this. And so I'm just, if I say this to you, Rob, I'm speechless. That's big. Okay, so let me give you some information. So if you're sitting and you're thinking about your insurance policy, like I was, just call him. Let me give you his phone number. He's here locally, but I'll give you an 800 number, so no matter where you are here in South Florida, it's 1-800-218-5033. That's 1-800-218-5033. You better pick up the phone, and you better call him, because you can call for your free life insurance review also. And you want to share some of the money he saves with me, I'll be glad to take it. It's 1-800-218-5033. And his website is US Insurance Auditors.com. He's like an auditor. That's what he's just done for us, for me. I can't wait to tell my husband. Now, just because I do want you to get into some other things now with what's happened with the economy, but I want to just say about my husband. So I brought him my husband's policy. Now, that's another point. And you can explain that maybe.
What this situation with everyone's policy is different. That's why there is no generic answer you can give to anybody on anything regarding their personal situation or policy, because it's all dependent on a person's age, the health, the time they've had that policy, because as you get older, the cost of insurance becomes more expensive. So if you started a policy in your older years, that cost of insurance would already be projected to be pretty high. It's exact opposite when you purchase something many years ago and you're younger. And sometimes the answer is you got to keep doing exactly what you're doing and pay those premiums. And that's exactly the case on your husband's policy. because if his policy is not overfunded, it's funded perfectly. And I can see that by running the illustrations we did for your husband. And that's why we don't guess anything. It's a mathematical formula. We don't invent them. The insurance companies do. And all we do, and the process, so everyone understands it, Anita, is simple. All we do is have you direct or sign a life insurance release form, and that allows me to do the work for you. And all we do is access the insurance company's illustrations and what's called a verification of coverage. That shows us exactly what your current account values are, what your surrender values are, how much to the dollar it would take to pay that policy going forward. And it also gives you the answer on, do I really have to pay the premium all the time, or can I skip a couple months? Can I skip a couple years, as in your case? You could skip many years. You could probably go 8-10 years on your policy with never paying that premium, and your policy would not lapse. Your husband's policy, because his cost of insurance is higher because he's a little bit older than you, he has to pay that exact plain premium because he has no cash value to fund that should there be any deficit.
That's clear. All right, clear as a bell, so we have that. All right, so that's Rob Colson telling us what we should do, what we shouldn't do, and the phone number to call him is 1-800-218-5033. I'm Anita Finley, and this is Boomer Times, and we're talking about life insurance as well as other kinds of financial paperwork. Tell me what, when you came in today, you were a little bit, strong about some stuff happening here.
Well, really the reason we started doing what we were doing in 1991 was we wanted to become risk adverse. What that means is I come from a stockbroking background, financial planning background. The world today is a lot different than it was when I got in this business. The last few days, the stock market's been all over the board. The Chinese have devalued their currency 2 days in a row. It's caused our markets to go down between 2 and 250 points at the open every day. And it's causing a lot of volatility in the markets. As a matter of fact, today was the first point in time of our calendar year that the S&P 500 actually went negative for the year. So most mutual funds, ETFs, trading platforms are based on the S&P 500, which is the 500 largest companies in America. But what's happened is, and you look back on stuff, and why do I say we're risk adverse? Because our planning methods take away the guesswork in the markets. And what does that mean? The products that we're doing more today, rather than taking people away from what they're currently doing, which we never do, we deal with people who are the risk adverse crowd, the people who are the boomers, the people who have built their nest eggs but are not willing to lose any more of their money. They still want participation. Many of them are in their 50s, 60s, still going to work another 10, 15, 20 years, but they cannot afford to lose any money. So what do? We have products available today that are hybrid products that allow you to win with the market but never lose with the market. Now, how could that be? What those products do is they have what's called an automatic step-up every month. So if you look at what the S&P 500 has done since the beginning of the year, it's gone up 10, 12, 15%, went back down, up 5%, went up 5%, down 1%. The volatility, if you just held an S&P 500 fund, has made you not one penny today because the S&P 500 is actually barely negative as of today's trading in the markets. So now what does that mean? What these products do, these annuity hybrid products, they allow you to step up and lock in values. So I'll give you an example. Let's say somebody started with $100,000. They had participation in the markets with no risk. What does that mean? The S&P went up. We had a good January, February. They either have monthly, quarterly, or annual what's called lock-in periods. So if that account went to $107,000 or $8,000 in January, that would be a high water mark that's called mark to the market. So that $108,000 account value stays at $108,000, even if the S&P 500 goes down 20% the following month.
You're very clear. That's very nice.
So what it allows the clients, consumers to do is participate in a percentage of the upside gains potential in the market. It gives them a bottom line guarantee on what it will pay. And a lot of them today offer what's called lifetime income riders. So now what does that mean? So let's say that $108,000 over the course of 5 years grows to $225,000.
Nice.
At the point of annuitization, they guarantee, those contracts guarantee that there's a 6% per year income rider being generated off that initial investment. How many investments today do you know they're guaranteeing 6%?
No, I don't know of any.
Exactly. So what these products allow you to do is safely accumulate wealth with no risk.
So in other words, it may have gone up to 200,000, but yet you won't lose. You'll lose some of it, but it'll never more than 6%.
You can't. No.
Not lose. Go ahead.
No. What happens is once the values are locked in, let's say it goes to 220. That would be your locked-in value.
Is that right?
Correct. So if the stock market crashed the following week, month, year, and the S&P went from 25, 22, 2,300 to 1,000, 50% of the market's value was pulled out, your annuitization value would still be $225,000.
How can they afford to do that?
It's the actuarial planning of each insurance company.
So why don't a lot of people do that?
They are. There's billions of dollars a month going into these products.
Okay, what kind of a product would, when they call you, what should they ask for?
That would be what we call an index annuity.
An index annuity.
Yep, and an index annuity allows you market participation through the indexes of your choice, and we help you pick those out with your risk profile. And they can be anywhere from treasury yields to bond yields to participation in a percentage of the S&P 500.
Now, should an older person have an annuity? Is that we've read that annuities are better for younger people than someone who's 75 and 80? It doesn't matter. Not for the index annuity.
No, an index annuity is a great product for people that are older. What's not a great product for people that are older, that a lot of people are still pushing heavily, especially in the brokerage wirehouses, because that's all they sell, are variable annuities.
That's it. So it's the variable annuity. You say no, right?
I would never write one on somebody in retirement or near retirement age, because they will have fluctuations in account values, and they're more. You're playing with the market.
Well, I have to tell you, which is interesting you mentioned it, but the time that Equitable was around, and my mother did have some money, and I was working with someone from Equitable, and they did put her in and she was, because they knew I was going to inherit it. I guess that's why. But they put her in one of those.
I meet with people every week. Every week. I actually got a couple customers off the radio show from you, and they came in. They were from Lighthouse Point, and obviously won't say their names, but we'll just give you their story. This woman's 87 years old. 3 years ago, husband passed away. I'm not going to say what company did it to her either, but a very known, top 5 company, brokerage house, sold her a variable annuity. She moved a lot of money into it, and 3 years later, she has less money than she put in there.
Oh, Rob.
Still has surrender charges on this annuity.
Oh, Rob.
So she can't move it, and which means I'm not allowed to 1035 exchange that product, which is a tax-free transfer of those assets into a new product, a fixed product for her, without a surrender charge, which I wouldn't do because it's just not good business. But here's this 87-year-old lady with a variable annuity whose account values are less today than 3 years ago.
But can't she go to a lawyer about that? That was not done properly.
You know what? She really could, and again, I'm in the business, so I don't encourage that stuff.
I know.
I honestly, you could.
I do. I'm hearing that because that's what gets people. That's what gets the business a bad name.
You're absolutely correct.
Well, I know you wouldn't, because you have your mother who is a nurse in one of our finest nursing facilities around here, but. And I know that you wouldn't do something like that, but this is a good warning to people listening that you need to really now have a second opinion, and you need to call Rob about a second opinion. So if she's really, pardon the expression, dead in the water.
And here's another thing going back to the beginning of our conversation today. People are sold products. Never hear from these people again.
I know that.
So here's an 87-year-old lady comes to me because she needs more income. Has a couple kids that are unemployed, and she's been paying their bills. So she's in arrears every month, And that's why she initially came to me. Well, this lady really has substantial wealth. She's just in the wrong stuff. So I asked her, I said, Mrs. Jones, I said, can I ask you why you're not annuitizing this contract? She looked at me like I was speaking Chinese.
Of course.
And she says, I don't know what you're talking about. So I got her to sign a release. I got all the illustrations for her back from Transamerica, which was the company she got the product from. And I could literally see the values had lost money. She's been playing the markets, obviously. She's in a variable annuity, and she's been losing money. And above and beyond that, she should have annuitized this contract from day one because she needs money. So that's what I'm going to help her do, is annuitize that contract. And then we have a portion of some other assets she has that have been dead for her for a while. And we're going to get her what's called an immediate annuity. So we'll take a fixed amount of dead assets she has, move them into a income annuity, and we'll generate approximately $2,700 a month for her.
Well, she can. Oh, that's a wonderful. I'm so happy that's wonderful. I feel so good about this. So for those of you, maybe your instance isn't exactly this way, but just give someone like I am, and I wouldn't now. I'm not going to do anything with that extra money. I got to think about what I'm going to. I think we're going to borrow the money from there and put it in something. I'm really thinking about that. So I'm very happy that you really got into this. This is kind of scary stuff. So what people shouldn't do now with the market going crazy is they either should just sit still, be quiet, or call you and see what you can do for them.
That's exactly correct.
Indexed annuity. Tell me what the negative of an indexed annuity is, because that probably there's something that maybe we should discuss.
The downsides to any annuity, and the reason insurance companies can project these 6% values, they can step up to the market, lock in your high values, but never give you the lows of the market. How can they do that, right? They do that because they can project that stuff over an entire population of people they have. So they can offset maybe a 40-year-old that bought one of these products versus a 60-year-old. So the downsides to any fixed product is time. It's time horizon. So you really need to explain to these people, this isn't a checking account, and it has what's called surrender charges. And surrender charges decline year to year. Every company has different ones. Some charge on a 10-year declining thing, so they might charge 10%, 9, 8, 7, all the way down. The more conservative companies aren't that aggressive. They might have a 5-year tear down. So the only downside to a fixed annuity or any annuity is your access to funds immediately. Now, does that mean Anita, if you put $100,000 in an annuity, you could never get that money out? Absolutely
just
not.
have to pay a surrender charge.
That's exactly right. And there's always a portion, usually about 10% of it, that's available right away. So if you put in 100, you needed 10 immediately back, you could get that.
So it's emergency money. It's really the way you had to look at it, right?
It is. And it's really, you have to look at, an annuity is no different than your 401k, your IRA, or any of that stuff. Because it's basically a retirement vehicle. It's not designed it's not a money market account. It's designed to put a fixed amount in that when you want to retire, you can call that company up and say it's time to annuitize that contract. So if you're in an index annuity, a variable annuity, those are going to grow until you say, I'm going to annuitize that contract. An immediate annuity, pay right away. It's just kind of like a CD, except with better tax advantages. You put in an X amount of dollars, you can start getting a check next month. Because that's what it's designed for, immediate income, normally for the retirement folks. But the other ones are going to build. Hopefully when you're in your 50s, your 60s, whenever that day is when you want to retire, you can call that company and say, guess what? It's time to annuitize my contract. And then they'll ask you, how would you like to be paid? Monthly, quarterly, annually? And most of those companies will have a lifetime income rider on that, which means you can't outlive that income.
All right. What about inheritance of these? Can this be part of your, I guess, your bundle that you're going to give to your kids? I mean, how do you do that? Is it just you?
Absolutely no.
So you have an indexed annuity and you can leave it to your family.
Absolutely. How these work are simple. there's a lot of ways they work. Let's keep this one simple. The index annuity. That product carries a death benefit, which is always higher than what you put into the contract. It also produces a growth that'll be commensurate to normally 6 to 8% growth in that growth account. And that's going to grow until you want to start taking that money out. So again, it's going to ratchet up to the highs when the market's good on the month. And if you have a monthly lock-in, it'll lock in that value. And then if what happened over the last 3 or 4 days happened, you wouldn't be worried about it, Anita, because you'd know your money in your annuity is still going to be on the high point from last month, where most people today are going to probably have a little bit of heartburn over the weekend when they look at their statements, because the market's been brutal this week and it's on a little bit of a downturn. But that's why I got into this business. I did 20 years ago, Anita, because the highs and the lows of the market are not a layman's game. This is a hedge fund run stock market. You hear all these people making millions and millions in the stock market. It's not Mrs. Jones from down the street. It's the hedge fund, the Bill Ackmans of the world, running the BlackRock funds and all these guys who are running these markets. So that for the little guy like me, I got to have some security, and I got to have a baseline knowing that I can never lose the principal I put in. You can't say that about any other investment in the world.
That's fantastic. I am so happy that you've taken the time to come here and do this and tell everybody. Let's go back to the inheritance again. So let's say it's a life insurance policy and I die. Mm-hmm. What if they don't want to collect? They just want to roll it over into keeping it? Is that what they would do?
They can do that. Let me explain that to you too. An immediate annuity. If you, let's say, I'll use a real life scenario. I have an 85-year-old lady. We calculate life expectancies, but generally a lady of that age is going to make it through her late 90s easily, because as you get older, the longevity stream goes even longer. So basically what that means is... No,
you know what? I'm going to stop you there for a minute, because I'm going to let this show stop, and I have another half an hour that I'm going to, if you have the time... You're on a roll, and I love this. And we'll put you on another one of our other stations so that we can continue. Is that all right with you?
That's fine.
Okay, let's just do that. So, all right, we've been talking to Rob Colson, and there's so much good stuff he's talking about. I'm going to hold him here, and we're going to get another 30 minutes out of him, if that's okay with our radio producer here. Are we going to have a little time? Well, what we'll do is we'll do as much as we can, because this is great information, and we'll just keep going. So just stay with us for a minute, and we'll be right back. Okay, so Rob Colson is here, and we've been talking a lot about what's happening in the market today. Now, I'm not really big into things like that, so I don't know much other than I just hear all the news people saying, oh, we're having a big time, because I don't really have investments in the stock market at this moment. But Rob Colson certainly knows what he's talking about, and I think this is so important. We started talking about life insurance, about what he's been able to do for me, but now we're getting into something even more interesting. Why don't you continue, maybe back up a little bit, and then let's continue with what you said.
Okay. What we were talking about, Anita, is you were asking me about what's the inheritance values and how does that work with annuities. So it's a good question. A lot of people are under the assumption that, they put these money in these annuities, they die tomorrow, the money's gone, everything's gone. They don't work like that anymore. Annuities today provide beneficiaries the remaining funds that aren't used over the course of the initial buyer's lifetime. Well, let me explain that to you. There's different type of immediate annuities you can buy. There's called period certain. There's called life with period certain. And basically what that means is a life with a period certain annuity will guarantee to pay the annuitant of the buyer of that annuity a payment for a minimum amount of time. So that period could be 5 years, 10 years, 15 years, 20 years. So let me explain how that works. Somebody puts in $100,000 into the annuity. Let's say that annuity pays them $900 a month. That $900 a month will be paid for on a period certain life annuity on the life of the owner of that annuity for their entire life. So let's say they're 85 years old. and we do a 10-year period certain annuity. That'll be guaranteed to pay a minimum of 10 years, but guaranteed for the life of the annuitant. Now, what does that mean?
But wait, but I'm getting $900 a month for that time.
Correct.
Always $900 a month.
It's always going to be a fixed amount.
Okay.
Yeah. So what happens is that person gets that contract, they start getting that monthly income. That will be paid for a minimum to the estate of the period, whether it's 10, 15, or 20 years, right? So if that person passes away prior to the 10 years, the beneficiaries will continue getting those payments for a minimum of 10 years.
Okay, I got that.
So that guarantees that the contract buyer gets 100% of their funds back guaranteed.
I see. And what's that called? Guaranteed?
That's called a life with period certain
life with
annuity.
Period certain. Okay.
Now, why would somebody do something like that? Well, because we see every day. You turn on the Today Show, they got 104, 105, 106, 108-year-old folks every week on the show.
Absolutely.
And a lot of them are still working. I don't know if you saw the gentleman last week. He was 106.
Fantastic.
And he still goes to work every day.
Of course. That's what's keeping him around.
Right. My grandmother lived to 105, and it's not a rare occurrence anymore. So people are living longer. So that buyer of that annuity, 85, will continue, if they live to 105, will continue to receive $900 a month till they die. So now they've taken away the risk of outliving their money. That's the beauty of it. So if that person's 85 years old, they know for a fact with the 10-year payment, anything happens to them, their estate, their kids are still going to get that money, right? If they live 20 more years, that insurance company is the one who loses. And that's the best part of it. It guarantees the income for life on the annuitant.
Okay, but there's nothing to inherit now because the person has lived much longer than okay, we got that now.
Yes.
All right. Now that's one term. What was the other term you used?
There's all kind of different annuitizing terms in there, but those are the main ones.
But
a life annuity,
one.
A period certain annuity,
period certain.
A life with period certain.
A life with period certain. This is
Right.
fabulous. You know so much about this. I would just hope that our listeners, whom I dearly love, and our readers can appreciate how fortunate we are now to find someone like you with a big heart, smart, and we're just not going to let people buy something that they don't fully understand. I think that's the big problem, isn't it?
It is, and that's why I never make recommendations until I've done what's called discovery. I have to sit down, talk, find out what your horizons are, what you and your husband's asset bases are, what you're trying to accomplish, how much longer you wish to keep working, and when you stop working, how much income are you going to have, and is it enough? And if it's not, then we can look at what you have, maybe make some suggestions to make that work for you. And what that means is there's all kind of dead assets, and they're most of the time they're in life insurance policies.
I was going to say, what's a dead asset? And you just answered it, life insurance policy.
It is, because a lot of times I will give you another example. People have old-fashioned life insurance was called whole life insurance, okay? Whole life insurance is a good product, but it was invented a long time ago. So what does that do? A lot of times, people have contributed as much as what that death benefit might be. What does that mean? They started 30 years ago, a $100,000 policy for Mass Mutual. They've been paying every month.
Just use me, because that's what I've been doing.
Yep.
Did I have whole life?
No, you have universal life.
Oh, universal life.
But the whole life's even more exaggerated than the universal life because it builds even more cash value. So more times than not, as people become older, the account values are almost as high as the death benefit. Well, what does that mean? I see people on a weekly basis that come in the office, and they think, okay, I bought a $250,000 life insurance policy, right? Bought it 30 years ago. I'm looking at it now. These people are still 10, 15, 20 years good left in their lifetime. Very healthy people. They have $230,000, $240,000 sitting in a life insurance policy that they're going to continue making payments on because they don't know any different. And when that guy dies or the mom, all they're going to get back from that insurance company is $250,000. So now what do? We sit there and we show them what they have, ask them why they bought the policy. The guy sits there and said, well, I bought it for my kids, and they're now in their 50s, and I don't even know why I have this. So then we take that and look at it and show them the reality of it. It's like giving a bank all of your money and getting 0% interest and saying you can keep it for 10, 15, 20 years. I don't care. I don't need to make
Can't believe this.
I don't need to make any money. So what initially we do is show them the facts, present the illustrations, and explain it to them in rational sense.
Okay, so tell us what we would do. Let's make believe that's really true. So someone has that policy. What would you suggest they should do?
They'd have to analyze their personal situation. And more times than not, I haven't met many people yet that don't want more income.
Well, they want more income. They want to go on a cruise. They want to do a lot of things. So how are they going to be able to keep up the $250,000 life insurance policy, though, that they do want to have covered and still have the cash? Because it was sitting.
There's a lot of different ways to skin the cat, but you're asking a lot of things in one. But I'll try and answer that.
You're good at that.
The most important thing is finding out what they need. What are their needs and wants? Okay, if they still have obligations, mortgages, outstanding credit card debt, loans on cars, then I'd advise probably more times than not keeping that policy. But do they need to keep all that money in that policy?
Exactly. I knew you were going to say that.
Absolutely not.
You're educating me.
Absolutely not. Because their fixed premium would stay the same. They could do what's called a 1035 exchange of a portion of those assets into an annuity, into any type of insurance product, so there's no taxable consequences. They'd still have that $250,000 life insurance. But that gentleman who has $237,000 in his whole life policy, if he took a loan against it on himself for $100,000, he'd still have plenty of cash to run the policy for the rest of his life, and he could produce probably $800,000, $900,000 a month for his lifetime.
Well, we're going to do something with mine because it's small. It's nothing like you're talking about, but it's still the same kind of a situation.
Yep.
We don't need it to sit in their pot of all that money they have, right? We need to pull it out. So typically over the many years you've been doing this is common, isn't it?
It is. It's very common. And the ability to do stuff today is a lot different than it was a decade ago, 15 years ago. And why is that? Because insurance costs are down. That's exactly why. Because the insurance costs are down tremendously over the last decade or so.
In other words, because people the insurance companies haven't had to pay out because people are living longer. Is that why?
That's exactly right. And actually
So you've really been educating me. I'm getting this. It's coming through.
You've been listening well, Anita.
I have been listening.
So that's another factor that's true, is that the insurance companies have adjusted their tables because all the life expectancy companies have actually come out over the last 3, 4, 5 years and said, we've been off. We've been off 30, 40% in our guesstimations.
But we're not going to go back to each one of our policyholders and tell them, hey, guess what? We're going to give you $100,000 back, right?
Yeah, they don't. The insurance, really what we do, and I work with all the insurance companies, we're not publicizing, we're trying to help people change anything they're currently doing. Any changes we make, and I want to make this as a point because this is very, very important. Any changes we do are regulated, so there's no swapping of paper. There's no doing anything unethical. Everything we do is monitored by not only the Department of Insurance but the Department of Financial Services, and we have to document exactly why we're doing that, and it has to be in the client's best interest, or the insurance company would never place the business. So it's not like we're going to people and going, oh, look, you have, $200,000 in here. Let me go spend this on something else for you. It's exactly the opposite. What we're doing is showing them and the insurance company, they're saying, why do you want to do this? Why would you take a loan out on this? Well, because I'm going to take that and I'm going to create $10,000 a year for these people to spend.
Absolutely.
And then there's
there's nothing for them to say against that.
There's nothing for them to say against
Except
it.
I'm sorry. I'm sorry. We should have helped them before, right?
That's right.
Because then they could have helped them and not have to give it to somebody else to do if they were really upfront and so would go back and say, look, there's $100,000 sitting here. It's not in your best interest. Why don't you reinvest it and do this? They would make more money. but they're not being. See, that's well. I'm glad you're doing it.
Well, what it does is it reduces their risk.
Sure.
What's the risk of an insurance company to pay you back $250,000 when they have $240 sitting in the account?
I know that's true.
And most people are going to continue paying the premiums.
Yeah, exactly.
And that's exactly what people do.
Because when Rob first saw the policy I have, he said, you have to stop making payments. And I the first thing I said to my husband is, I really trust Rob, and I know that, but what are they going to do to me if I stop making the payments? I was scared in a way. But then you really reassured me I don't have to be scared. And tomorrow I'm going to the bank because it'll be too late today. And I'm going to tell them stop making that payment. That usually comes out on the 18th of the month. So I'm going to get $161 that I didn't have, and a lot more because we're going to take some of that money and do something with it here. But this is really fascinating. All right, so now we've really covered that part of insurance. Do you think we should cover a little bit about what your article was in last month? When you said life insurance, it's as saleable as stocks and bonds. Like my husband had done something like this. He really sold his policy. Do you want people to sell the policy?
Only if they have an unwanted need for that policy anymore. I don't encourage anyone to do anything other than what they need. And what does that mean? What we do is we analyze insurance. We can analyze life expectancies. We can project out how long it might cost to carry that policy based on your life expectancy. So what we do is create a scientific model that can show you what's called the internal rate of return on your policy. And it can tell you to the point of somebody's life expectancy what their current return is. So now what does that mean? If you bought a policy years ago and your needs have changed, your kids are grown up, you don't have any mortgages left on the home, and you're still out there working a bit or you're not working and you're coming up short any week or month, there's a lot of things you can be doing with that asset. And people don't look at that life insurance policy as an asset. You have $23,000 sitting in yours. You didn't look
Ridiculous.
at that as an asset.
Never. And I needed it.
And you're looking at this as a liability when really it's an asset.
I really did.
Right.
And I really, I really needed that for something else that I actually have borrowed against a credit card to do. I mean, I'm just telling everybody all my business, but this is why it's so powerful for me today.
That's right.
For what you've done. And I'm probably a small potato compared to people who've had lots of money that they've put aside and they need it, and maybe people are suffering from, I was just thinking, people don't want to buy long-term health care insurance because it's too expensive, even though I've had it for many years. But think about it now, and I know you would sell it also if they wanted. So they could take it out of this. Let's say they had a $300,000 life insurance policy. They could take that money out now and use it for long-term health care insurance, which would really just cripple them if they really needed it. That's
the number one reason people sell policies today is medical bills. 80% of bankruptcies in America today come from medical bills, if you can believe this. So people either can't afford, they don't have insurance, but 80% of bankruptcies are generated directly from medical billing. So that's the number one reason people do it, okay? Quick access to cash. But people's needs change, and that's another thing you brought it up, so I'm going to extrapolate on that just a little bit here. There's all type of hybrid life insurance today that also gives you long-term care help. Now, how does this work? If people are worried about long-term care, and they should be, facilities are extremely expensive, as you well know.
Well, I have to just tell you that someone was on my show earlier, and for a double in a room, $8,000 a month.
That's exactly right. Can you believe that's just astronomical? So let me explain a little planning strategy that's available for people. A lot of people have several needs, and we can kill a couple birds with one stone. Through a life insurance policy today, they allow you what's called a long-term care rider. So let's keep numbers simple and easy for explanation purposes. A person comes in the office, says, I have 4 kids, I'm 55 years old, I have a business, my wife's a nurse, we work, I need life insurance, don't have any, my wife said I need to get life insurance. My other concern is, I'm 55, my dad just went in a hospital, I just had to come up with $200,000 to put him in St. Andrews Estates. On top of that, Even after I give him the $200,000, I'm going to pay him $4,000 a month. I need help. What can you do? I'm worried about it. This might happen to me. What am I going to do? My family can't do this. So we can plan for that gentleman that he can purchase a life insurance policy. Keep numbers easy, say it's $1 million. What those certain carriers with those riders allow you to do is access between 25 and 50% of the death benefit immediately if something happened to you and you were put into a facility. So that guy is now 65 years old. He has a stroke. He's in a wheelchair. Wife says, oh, my goodness, what are we going to do now? What am I going to do? He would be able to access that on an accelerated basis between $250,000 and $500,000 of that death benefit to pay for St. Andrew's Estates. So he's killed two birds with one stone. While he's working from 55 to 65, he has 4 kids, he has a wife. If he passes away, they get $1 million tax-free. If he ends up like his father, hopefully his kids will be able to help him, but God forbid they can't, he can help himself. He can call up his carrier. His wife can call up his carrier. I guess if he has a stroke, she'll be making that call. And they can say, my husband's a stroke, he's in Boca Hospital. I need to move him over to St. Andrew's Estates. We need $200,000 off this policy for our down payment on our townhouse over here. And that's exactly what they'll do. If you can't do 2 of the 6 faculties of life, they'll accelerate that rider. So that's an ingenious product. It's one of the best sellers you have in the 50 to 60 market right now.
That's fabulous. And he still has life insurance. And now he has the money to be able to get in there. Now they have to still have money to pay for the long-term care.
He could also keep accessing the death benefit, because remember, he could access up to 50% of the death benefit.
Right.
So if he had $1 million policy,
sure,
he'd have $500,000.
Yes.
So, would it pay for his whole longevity there? I don't know. I don't know how long he's going to live. But what I do know is the amount of premiums, let's say on a $1 million policy on a 55-year-old, let's say they're $25,000 a year, guesstimation purposes. Probably a lot cheaper than that, probably around 15 to 20. There's no way he would ever get. How long would it take him, based on that in his checking account, to build up $500,000?
Not possible.
It would take 25 years.
It's not going to happen, right?
It would take 25 years. So look at the value of that product for that guy or anybody, that woman. They have a planned strategy, and how can the insurance company do that? Simple. They have collateralized it with the $1 million life insurance policy.
I see. Yeah, that's great. So, but that has to be a specific kind of a policy. So, just taking bills, for example, which is just a straight policy, it can't be done. So, when you first go in, you need to know that's what should happen. So, you're gonna do that with someone. Oh, that's really good. I don't know why anybody would be buying life insurance today without that policy. Do you?
Well, because here's why.
Okay.
Every rider you have on a policy costs a little bit of money. So if you're in the market and your idea is to get, and I'm a broker, I sell every product. So if you come to me and say, Robert, I'm adamant, I need the cheapest $1 million A-rated carrier you can get me, it's not going to have that rider on there. It may be pennies on the dollar higher for that rider. But again, it's each person's profile. I meet many people today. They're in their 40s. They think
I'm not going to a nursing home. Forget it, right?
They think they're Superman. Right. I bring up a long-term care rider. They look at me like I'm speaking to Russia to them.
Exactly.
Now, because they've never had that happen to them. I've had it happen to my immediate family, and I don't know any person who's getting older today that doesn't have somebody in their immediate family that has a situation. We're all coming into that age. Who's going to take care of us after everyone's gone? We'll probably all end up in one of those facilities one day, Anita.
And you don't want to have to go in with Medicaid if you can find one. You want to do it so that at least you're having good care. I was thinking your next article should be on that policy. I think that's a fabulous policy. I mean, is that well known? I haven't heard of it.
Not really. It is not. Because, again, when you go to a specific company, not a broker who sells for everybody, they have a limited product line for you. And I'm not even going to say their names, but their buildings all over I-95 going down towards Miami Airport. You see them on the side of the road?
Right.
They could only sell for those companies.
Okay.
So if they sell for Snoopy, Snoopy products are all they could sell. That gives them a very limited pool from what to buy from. When we're a broker, I can shop John Hancock, Transamerica, AXA, AIG, any bells and whistles we need. We can build that product pretty much, or they're already built. We're just going to figure out what's the right fit for that client.
Well, that makes a lot of sense, and I was just thinking about when Bill had a very large policy, and then we didn't decide we didn't need it. We needed the cash, and we were able to do it. And people buy that; they buy that policy so that they give him the cash, and then and of course that's an investment for them because they figure that when he dies, it's so funny. I've said this every 3 months we get a call. Hello, how's Bill doing? Because they're all waiting, rubbing their hands together. I said, he's not going to die for another 10 years, so stop calling. Because but we went into a huge pool. Of course, they're not just waiting, but yet they call and they want to know if he's still okay because they bought into that thinking, well, the odds were against him with so many of his, some of his physical problems. And so it's all money, isn't it? Big investment.
It is. And you're exactly right. It's an investment for investment bankers and buyers, and the buyers of these products are the biggest ones in the world. Right. The Berkshire Hathaways, the Warren Buffetts are the ones buying these things, and
they know people are going to die. We just don't know when, right? And that's what they're taking. It's pardon the expression, a crapshoot in a sense.
Well, it is, and everyone thinks that the buyers of these policies are making out like bandits. As you said right there, they call you every 3 months. Your husband will probably outlive the people calling him.
Right, I know. That's right.
And what happened is when the actuarials have come out and said, guys, sorry, we're off 30 to 40%. That's like telling people, guess what? Your mortgage was calculated. Instead of 30 years, it's 40 years. Instead of a 15-year mortgage, 22. That's what they did to these buyers. So guess what? Imagine if you had to pay a 40-year mortgage instead of a 30, or a 21-year mortgage instead of...
Because every month, these people have to pay a certain amount, or every quarter, or every 6 months. They're paying some big dollars in there to keep that policy up.
They're paying 100% of the premiums to carry the policy.
Right.
And on top of the fact of the amount of money they put up to buy that policy.
That's right, exactly.
So,
which we got.
So let's say they're financial calculators. Yeah. I think a few of them blew up.
Yeah, okay, well, but most of them have so much money, it probably is just a drop in their bucket, but whatever it is. But we certainly have learned a lot. And the first part, the first show that you did this before the other day, and now this really combines it. And I think that your articles are very good because people really don't know this information. One thing about you is, two things. You're very clear. You speak very, very much so that people understand every little bit that you're saying. You don't cover it with things. The second thing is because of your mother being in the healthcare business for so long, you're very, very cognizant of what an older person needs. And I really like that. You think that's true? Why?
I definitely do. As you know from my family, I speak from facts.
Right, and the heart.
My father lived every part of the stories I just told you about today.
Yeah.
The life insurance parts, the assisted living parts, every bit of it. And you're exactly accurate on what you said those costs are, because my mother works in one of those facilities, and it was very, very expensive. And thank goodness we had the planning we did, for my father and for our state and everything we did. But I carry everybody's business from like I do my own family's. Because it's the most important thing in your life is your financial, but other than your health and your wealth. That's what we like to say, but the health is always first, because there's nothing better. Without your health, you don't have anything today.
And also, we haven't really, go back to that 40 and 50-year-old. Are they buying insurance now? But talk about the term. Aren't a lot of them just buying term insurance because they're just thinking, well, just in case something happens to me? I guess it goes up to 70. What is it when term insurance is so cheap?
Talk
about term insurance.
Term insurance is cheap because, frankly, 89% of those policies have never paid a death benefit. So the insurance company is winning 9 out of 10 times. And why are people buying them? Because they're cheap. And, again, I understand. I get it. Whatever that customer client budget is, We'll do what we can for that. Obviously, fixed products are a lot better because, as people always say, you know what? I'm 40. I got kids. They're 10. They're going to be out of the house in 15 years. They'll be 25. No more responsibility. Well, I'm sure you know that's not reality. And the kids are always going to be around. I hate to break the news flash to you.
That's right. My son just came by. He's in his 50s, and his one son, and he sells cars, and he was having a bad month, and he came begging. So I mean, it's like. And
so that's why. And then now they're 55 years old. They bought the term when they're 40 because they only wanted to pay $125 a month for $1 million life insurance policy. And then guess what happens when they're 55, Anita? They still owe X amount on their homes. They still have kids in college. They still are both the two working households. And guess what? Mom still wants dad to have some life insurance. So now they're going to come back at 55 wanting to buy that $1 million policy. So instead of what could have been a $250 $1 million policy at 40 is now probably $2,000 a month at 55.
Oh, well, there's no way they're going to do that.
If they have the means,
so that's very good that you said that. So the difference of buying the term at an early age and doing it as a whole life or one of the other insurance policies is maybe twice. So if they're paying $125, it could be $250, and then
at least.
And they have so much that goes with it.
Yep. And again, people look at the life insurance like it's just for death benefit. And we'll do this on the next show because I want to get into that with you. Because life insurance is the best proven tax-free guaranteed income generator there is.
Okay, with that, I think we're just going to turn this show off. That was so wonderful that you said that. So I guess we're finished, right? We're finished. Thank you, Rob. And people just call 1-800-218-5033. Thanks so much.
Thank you.